Hey everyone, this is Natalie Pace, and welcome to our free video conference. This is August 8th, 2024, and today's topic is how to earn 4 to 5% safely without those pesky paper losses. So I want to show you a couple of things because we have seen the markets go a little bit crazy, as well as the yield has been dropping a little bit on our bonds. And that is all due to an expectation that the Federal Reserve Board is going to cut interest rates in September. So let's just take a look at some of the numbers real quickly, and then I'll show you a few other things that I wanted to talk about today about how you can, again, avoid paper losses, because you want to make sure that you keep your wealth on the safe side. A paper loss, right? If you have to buy a house or you want to do other things with that money, a paper loss actually can lower your credit score. Of course, it prevents you from accessing that money. So having a paper loss for a decade, or some people it's 30 years that they might have a paper loss. This is not a desirable outcome. So this very important topic that we're talking about here. All right, but we're starting with a few of the basics. And the first thing is that you're still not getting paid to take on the risk of long-term bonds, right? And that's part of the reason why we have paper losses. So we do have what's called a duration risk. So here, if you want to get a 4% safely and lock it in for a longer term, I might think about that 2-year. Maybe go up to 5-year. At this point, due to the amount of credit risk in the world, which is in the United States, it's about 99 trillion total debt and loans. I know we always hear about that 35 trillion in public debt, but the total debt and loans is 99. That includes a lot of the other debt, like consumer debt and corporate debt and other things like that, bank debt. So with the amount of debt out there, which adds credit risk, duration risk is a problem. And of course, what you're seeing is you're getting paid more for the short term. So you're getting paid more to take on less risk. So if I were in your shoes, I might want to go for the rolling maturity dates of the smaller duration or the shorter duration, maybe lock in a 2-year, at most a 5-year. So you're almost getting that 4%. Again, that way, if there is any paper losses in your portfolio, then it's only for 2 years or 5 years instead of 30 years or longer. So that's one of the things I want to show you. The other thing I want to show you is that the market is pricing in rate cut in September. It's 100% expected from a market point of view. Okay, so this is the CME Fed Watch tool, and you can see that about 43% expect of 25 basis points, and another 56.5 expect 50 basis points. Now, when the Federal Reserve Board Chairman Jerome Powell had his press conference, he said that 50-point rate cut was not on the table. But of course, things can change if the data, it says. And of course, last week, the data was pointing towards more of a rate cut. And this week, the unemployment looked a little bit better than it did last week. So of course, it's going to be data dependent on whether or not there is an interest rate of cut, which is highly expected, 100% expected, of 25 basis points or 50 basis points. The Fed said 25 would be what it would be. Of course, what the futures is saying that it's more likely to be 50. Now, here is where we are right now, right? So the interest rate right now from the Fed fund rate is 5.25 to 5.5. And again, as we looked at the par yield rate of what's going on, if you wanted to get that kind of rate, you're looking at a very short term, right? The longer term is paying you less. So the mantra I would say right now is keep the terms short and the credit worthiness high. Now, why the credit worthiness high? And that I just told you about the debt, but over half of the S&P 500 is at or near junk bond status. That's a lot of credit risk. And when they get downgraded, they have to cut their dividend. So those of you that are looking for dividends in the high yield market, that's a risk. And then the other thing is that you can lose principal. And of course, your bond could become illiquid or negative yielding or paper losses, that sort of thing. So an illiquid bond, what does that mean? That means that nobody wants to take your bond off your hands for you. So you do have to hold it to duration. And how many of us are going to live another 40 years? Or is it possible that that company will have to declare bankruptcy and restructure their debt in between now and 40 years from now? So it's really important to know both the creditworthiness and the duration of the bond. And also, you're getting a lot of bloggers that are saying, hey, jump into these high yield dividends. So I just wanted to address that real quickly. When you see a dividend that's 10% and the interest rate is 5, that means that you're probably going into junk bond status. And remember that when a company gets into trouble, the first thing they do is cut their dividend. And the minute that happens, there's a gap down in the share price. So you're really taking on a lot of risk in today's world by going into junk bond status. So I would say probably want to avoid that. So bond funds, what about those? Well, we have seen that bond funds are losing value, so they have been a problem as well. Part of the reason is because of what was the interest rate risk. That's abating a little bit, but there is still duration risk and credit risk. And those exist in bonds because a bond fund typically will have mixed duration. So they call it a laddered approach. But they can also have mortgage-backed securities in there. And oftentimes those, especially if they're commercial real estate, are a lot more distressed than people might realize. And they can have up to 20% junk bonds, even in an investment grade bond fund. So I would be underweighting bond funds right now. Mortgage-backed securities, I would be underweighting. Junk bonds, I would be avoiding. Managed plans tend to, especially if you ask for a conservative portfolio, will try to either take that laddered approach through bond funds or through a bond portfolio. So it's not as easy as just saying, I'm conservative and I want to earn, 5% or 4% safely, because they may have this, template of how they do that for you that does include both duration risk and credit risk. So a lot of our banks are at the lowest rung of investment grade. So it's pretty important that you know what you own and why, and that you're not just listening to what you're being told, but that you're actually seeing that what you're being told is also being reflected in your statement. I have seen incongruities there where someone's being told one thing and what's actually written on their statement, which is the truth, and what is really happening is very different and potentially more distressing. So again, duration risk is a problem. So I would keep the term short. What does that mean? Under 5 years for sure. Rolling maturity dates so that I have access to that money, because if if we do hit a recession and stocks go down, you might want to buy stocks at a lower price. If we hit a recession and real estate prices go down, you might want to buy real estate at a lower price. We talked about the credit risk, and we've talked about paper losses. So again, the long and the short of it in today's world is that you are going to be able to still earn 4 to 5%. If you want 5%, you're probably looking at a duration of 6 months or less, right? If you want to go ahead and try to lock in close to 4%, 2 years, maybe 5 years, I would not go all the way out to beyond that, because again, you still do have those risks, liquidity, duration, and credit risk, which could actually mean that if you purchase something longer term, that you do have paper losses and that maybe nobody wants to buy it from you. So those paper losses become real unless you can wait till 30 years from now or whatever the term is. All right, so remember, I'm going to post a blog about this at nataliepace.com/blog. Also, you want to subscribe because I do these video conferences at least once a month. We want to hear from you. What are your money triumphs? What are your money challenges? What are you excited about investing in that you want us to look a little deeper at? Email info@nataliepace.com. Also, let's have some more robust conversations on social media about this. You can follow me at Instagram, Natalie Wynn Pace. Wynn is my middle name, and it's Wynnne. You can follow me on Facebook, same, or the ABCs of Money. And I'm also on X at Natalie Pace. So thanks again for joining me. And I will see you soon. At least we may do one more video conference in August, or we may take a holiday. And also, look out because I'm going to be posting and publishing the 6th edition of the ABCs of Money within the next 60 days. Look for that and look for our summer sweepstakes, and do join us in October for our financial freedom retreat. And by the way, we're having a bond masterclass the Saturday after the financial freedom retreat. So you definitely want to register for that. You'll have a link in our video on YouTube as well as in the blog. All right, I will see you then again next time, and thank you for joining me.